Do you need 20% down to buy a home? In most cases, no. But the down payment is not the only expense you need to prepare for. Buyers are sometimes surprised by the money needed before closing, at closing, and after they receive the keys. I'm ReAnn Gonzalez with Edge Home Finance. I have more than 30 years of mortgage experience helping buyers throughout El Paso, Fort Bliss, Las Cruces, Santa Teresa, Sunland Park, and southern New Mexico. Okay, so now let's get into it. Let's break down the money you may need when buying a home. First is your down payment. The amount depends on the loan program and your qualifications. VA loans may offer no required down payment for eligible service members and veterans. USDA loans may also offer no required down payment when both the buyer and property meet the program requirements. FHA loans generally require a minimum down payment of 3.5%. Certain conventional programs may start at 3% down, and down payment assistance programs may be available for qualified buyers. So, you may not need 20% down. However, a no down payment loan does not necessarily mean you will have no out-of-pocket expenses. The second category is earnest money, and in Texas, the option fee. These amounts are negotiated in the purchase contract and are normally due shortly after the offer is accepted. Earnest money is generally credited back to you as part of the transaction at closing. However, you still need to have that money available when you go under contract. The third expense is the home inspection. The buyer normally pays the inspector directly. Depending on the property, you may also want or need additional inspections, such as a sewer, septic, well, roof, foundation, or pest inspection. These expenses are generally paid before closing and should be included in your home buying budget. The fourth expense is the appraisal. Depending on the lender and the transaction, the appraisal may be paid upfront or included in the closing cost structure. In some cases, an appraisal waiver may be available, but buyers should not count on receiving one when planning their funds. Next are the closing costs and prepaid expenses. These may include lender fees, title-related charges, homeowners insurance, prepaid interest, and the initial escrow deposits for property taxes and insurance. Closing costs are separate from your down payment. Seller concessions or lender credits may help cover some of these expenses, but they must be negotiated correctly. They are also subject to the loan program's limits and the property's appraised value. This is why I recommend involving the lender before the offer is written. We can determine how much assistance you may need and whether the proposed seller contribution can actually be used. Finally, do not forget about reserves. Using every dollar you have to purchase the house can put you in a difficult position when moving expenses, utility deposits, repairs, or unexpected costs come up. You do not necessarily need a large emergency fund, but you should have some money left after closing. The total loan amount needed is different for every buyer. It depends on the purchase price, loan program, property, contract terms, seller concessions, and your financial qualifications. You may need less money than you think, but you need a complete plan before you begin making offers. Before you make an offer, send me the property address. I'll help you understand the real payment, cash to close, taxes, and loan options before you move forward. Please like, share, and subscribe for more mortgage tips.